Hello and welcome to the Assay. Today, I am happy to be joined by John Forwood of Lowell Resources Funds Management. John, it's great to catch up with you again.
Thanks, Amy. I think it's the first time this year. Yeah, thanks for having me on the Assay.
Absolutely. And I mean, it has been quite a while since we last caught up. So maybe could we just do a very quick introduction to yourself and Lowell?
Yeah, look, I've been with the Lowell Resources Fund since 2016. The fund is focused on junior resources, and we invest sort of across the board. ASX listed stocks, TSX and CSE listed stocks, and a few unlisted stocks as well. And we're across the board also in commodities, so everything from precious metals right through to energy. And yeah, with a real sort of bent towards the exploration side of things. Yeah.
Okay, excellent. And so you mentioned that you're pretty much kind of broadly focused across the whole commodity spectrum. So, maybe you could talk a little bit about how the various markets like precious metals, critical minerals, how are these gonna fare moving forward?
Yeah, look, I think we're more than 50% weighted to precious metals, and then about a bit more than 15% in copper in particular. And yeah, not unlike a lot of investors, we like those two commodities. We think they're going to continue to do well. They have done very well. Obviously, the gold price has hit record highs in the first half of this year, and the copper price, while it is very divergent, if you like, between the different markets at the moment due to the impending tariffs, the copper price has also done very well. Trading at $4, around $4.50 a pound as we speak, and on the LME, and up to $5.50 a pound on the COMEX. So they have done well, and we've seen money start to flow into the equities that are exposed to those commodities. I think, yeah, gold in particular, it looks more and more likely that interest rates in the US, when Jay Powell departs, will come down, and that will be favourable both for the gold price in US dollar terms and for more speculative stocks, which we sort of focus on. So, and on top of that, central bank buying in gold has been a big driver of the gold price, and that we can't see that going away, particularly out of China, as China tries to, and other countries tries to de-dollarize their central bank reserves. So look, the number of fundamental drivers for gold are very good, and copper, look. It's a little bit hard to read and is a little bit messy because you see massive build out of copper smelting capacity in China. So there actually are negative treatment charges being paid to treat copper concentrates, whereas in some parts of the world there's probably plenty of copper, particularly in the US at the moment, as copper's rushed in there ahead of the tariffs, whereas in other parts of the world there might be a bit of a shortage, and some of the warehouses are running a bit low, particularly in Asia. So it's a little bit of a messier picture, but the long-term fundamentals of copper are continue to be very good, particularly with the build out of electricity demand for AI.
Yeah, absolutely. And so, you started to get into it, but there's been quite a bit of volatility across different commodities in terms of pricing. But how do you at Lowell kind of balance these market conditions with your kind of more long-term investment plans?
Yeah, look, I think investing in what you might call more venture capital style opportunities in the resources sector, i.e. exploration, means that those companies are going to be capital hungry. They're not generating cash flow pre-development. So you've got to take a longer term view, and generally we try and keep some powder dry or the next time there's a capital raise for a particular investment. And typically, I don't know what the average is, but maybe once a year you might see a junior explorer come back to the market to raise more funds, and assuming that explorer or that company has done, hit its milestones and done what it said it was going to do, then the valuation is still attractive, then we'll look to invest and put more money to work in that particular stock. So yeah, look, we take a horizon of 3 to 5 years, and some stocks can take a lot longer than that, and then come good. So yeah, you've got to really look through the near-term volatility and take a long-term view.
Okay, excellent. And so, looking at the Australian market, how would you characterize the health of the junior exploration sector there right now? And does it differ from what you see globally?
Yeah, there has been quite a big divergence, particularly between, the two major mining equity markets, being the ASX and the TSX or the TSXV. In Australia, it has been more buoyant. Here, I wouldn't say it's been, a boom, but certainly in comparison to North America, there's been a lot more interest in the resources sector and the junior resources sector, and we've seen, some really good performances and of stocks, and we've seen quite a lot of money raised, particularly for gold, but also for other things like rare earths, for example. So yeah, Australia's been reasonably strong. Having said that, the actual data for money being spent on exploration shows that we've had a little bit of a fall over the last 6 to 12 months. Contrast that with Canada, or North America, I should say, the TSXV Metals and Mining Index has really struggled over probably the 4 or 5 years to the end of 2024, December 24. It's a very, very tough period. But if you look at that index over the first half of this year, it's up almost 50% from a very low base, but there's been a really significant recovery. So we're starting to see interest come back into the sector in North America. And I think, it sort of coincides with perhaps some of the AI and tech stocks in North America perhaps topping out a bit. We saw that DeepSeek moment back in January, February this year, when there was a bit of a concern about some of the AI stocks. And yeah, I think there has been a very, very small rotation, but that's all it takes out of some of those very big sectors into the mining sector, which is, relatively a very small sector.
Yeah, absolutely. And so, I thought we could look at not kind of exactly what you look for, but what do you think some of the biggest mistakes juniors can make that can kind of hinder their chances of gaining this type of investment that you might be offering?
Yeah, look, I think there's a lot of temptations for companies out there to chase the market, if you like. Yeah, we did see a lot of companies, with the lithium boom, realized that they had some lithium mineralization on their tenements and chase that, and then with the crash in the lithium market, there's been no interest in lithium for the last 12 to 18 months. So that's sort of one example of a mistake you could arguably make, that chasing a more niche commodity which has run really hard. You've got to be careful when that happens. I think look, junior companies, that time is money. Got to, and drilling is is key for news flow. So you've got to have projects that can be drilled quickly and efficiently and tested and turned over. So that's a real challenge for junior companies. It's getting harder and harder to get drill permits, and can take years and hundreds of thousands of dollars to actually be able to get drill access for a project. So you've got to focus on projects which are more readily able to be accessed. So, hey, look, that's just a couple of things. There's lots of pitfalls, but there's a few lessons there.
Yeah, absolutely. Definitely some good takeaways. And then just kind of finally looking ahead at the next 12 to 24 months, are there any kind of key drivers or key developments looking at, macroeconomics, geopolitics that you think are going to help kind of shape opportunities or create challenges for the junior mining space?
Yeah, look, I think, one of the big macro ones is Jay Powell leaving the Fed, and that will happen in May and possibly before. And he will almost certainly be replaced by a Fed chair who is going to be much more amenable to cutting interest rates. So yeah, I think that's the overarching thing that will happen in the next 12 months, and that lower interest rates in the US it may be a sugar hit, but it will be good for both the gold price and junior resources. I think, beyond that, my crystal ball is very cloudy. But I think, just harking back to copper, I think that, in the midterm, maybe, sort of 2 to 3 year time frame, we're going to see, shortages start to become more apparent, and that'll should be reflected in the price.
Yeah, absolutely. Definitely kind of one of the key commodities to be watching at the moment. So John, those were all the questions that I had for you today. I want to thank you for joining us here today at the Assay, and we definitely hope to be able to catch up soon at one of the one-to-one events.
That's a pleasure. Thank you, Amy, and look forward to catching up.
Thank you.